You're listening to The Local Maximum, episode 240.
Time to expand your perspective. Welcome to The Local Maximum. Now, here's your host, Max Sklar.
Welcome, everyone. Welcome. You have reached another Local Maximum. I know for those of you guys who are watching the video, I've rearranged things a little bit. It might be a little bit weird, but why not try something different every once in a while? Yes, this is a fully solo show on video, which is always very interesting. So how are you? It's, what is it? Monday, August, I don't even know what it is. August 22nd, 2022. Just finished up this last week with the Better Call Saul finale. I don't know who else saw that, but I have been really into Better Call Saul over the last few years, and I thought they really finished up the show very well. I don't want to give any spoilers, of course, but it's well worth listening to, and of course, that's the end of the Breaking Bad universe. So end of an era. So now it's Monday night, and I have nothing to do. Very very different, except put out the podcast, of course. But after I put out the podcast, because Better Call Saul came out at 9, and this podcast has come out at 8. I'd love to talk about it, but we can't do spoilers. So let's move on to the topic of the day. We're going to talk about the cryptoverse, the Cryptocosm, or whatever you're going to call it today. I have a little bit more to add because there have been so many developments. And then later on, our distribution of the week is the multinomial distribution. So we'll get into that as well. So crypto, I believe that right now, cryptocurrency is turning a corner into the unknown, because back in episode 233, that was maybe a month and a half ago, we covered the start of what has been called the crypto winter. This isn't the first crypto winter. There's been plenty of crypto winters, in the past. There was one famously in 2015, throughout 2015, really parts of 2014 to 2015. That was the Mt. Gox crypto winter. There was one in 2018 to 2019 that was pretty bad, and then there's one right now. And each time we've gotten out of it, and very interesting things have happened during that winter, which is, you use these terms crypto winter, but I think really what we're talking about is when it comes to emerging technology, there's often a hype, and then there's a trough of disillusionment, as it's called, and then it comes back. As you know, it's also known as, let's use a simpler term, the hype cycle. So of course, all of these new technologies come in hype cycles, and so we discussed the start of what's called this latest crypto winter back in early July in the midst of a series of token collapses, which led to some actual companies going bankrupt and liquidity crunches and all that. The so-called crypto contagion, and that's stuff that happens, in finance when things go wrong. And a few more of those aftershocks have occurred since that last episode, the last time we spoke about this, but that's not really what we cover here on the Local Maximum. I'm not too interested in, I might be interested, in it, but I feel like it's not good for the podcast to cover what's going on with every little crypto company. What's interesting about crypto winter, any trough of disillusionment, valley of disillusionment in emerging technology, is what's happening underneath. How is the technology changing? How are the plates shifting this winter that will set up either the next phase of crypto adoption or the next wave of innovations, or possibly, the next bull run, if you want to think of it in terms of investors? I think there are people who talk about crypto and they say, well, the investment side is evil, and then, we only care about the technology. That's what people say in the winter. Oh, the price is down. We care only about the technology. And then, there are people who don't care at all about the technology and only want to make money. But, if you're interested in technology, I think you should be interested in the in the trades to make as well, just to play along with it, because that's an important part of the technology. But I'm kind of getting on here. Let's get into it. Several big changes are coming down the line. The large gorilla in the room over the next month is the so-called Ethereum Merge, which I believe it's happening on September 15th or so, somewhere around there. This is happening in September. What is it? So the proof of work. Ethereum is moving from proof of work to proof of stake. What is proof of work? Proof of work is the original system proposed by Satoshi Nakamoto in the Bitcoin white paper. Bitcoin was the first cryptocurrency, and it used proof of work, where coins are rewarded to so-called miners who did the most work on average because, they broke a cryptographic hash. You could break a cryptographic hash on the first try, but on average, there's a certain amount of time it takes to break a cryptographic hash. And so the ones who, the miners who do it the most, have the most, we can surmise, have the most computing power because there's no kind of shortcuts to doing those computations. So this scheme solved the inherent problem of scarcity and double spending in digital assets. Because if you were just, the alternative is either to have the ledger, how much Bitcoin does everyone have, is to have it in a database, and then you're just a company, and there's nothing too interesting about that. And those types of currencies have been shut down before, and it wouldn't have a purpose. And then if you want it to be decentralized, if you don't solve this problem, then the question of who owns what and how can you get people to agree can't be solved. So this solved that problem. The proof of stake concept is an alternative. It's not based on who did the most work. It's based on who has the most value in the system. So, for example, if it were Bitcoin, Bitcoin is not proof of stake, but if it were, I would stake some Bitcoin. In other words, I'd own it, I'd lock it somehow, and that gives me kind of votes in determining how the system is going to proceed, like which, what the next block is and all of that, and which transactions go through. And so the people who have the most value in the system, now they get control over it. Now, of course, there's a problem of distributing the coins in the first place if you're going to do that, because if you have proof of stake, okay, the people who own the most coins have control. Who starts out owning the most coins? Ethereum is not going to have this problem because they've already distributed this through proof of work. And also, proof of stake doesn't solve the scarcity problem like proof of work does as well at first. And it seems like there are a few ways to hack it, and a few kind of programming hacks are needed to ensure that it's actually expensive and very difficult to double spend, particularly if someone has, let's say someone has a ton of Ethereum, can they just use that to double spend in the system? But a lot of safeguards have been experimented with, put into place, a lot of different schemes. Proof of stake coins have existed for around 10 years. I believe the first one came out in 2012. That was Peercoin. And these problems have been ironed out for a long time. So what is the hoped for outcome for the Ethereum developers, for the people who are pushing this change? Without proof of work, Ethereum miners are put out of business. This is kind of a double-edged sword. And by the way, Ethereum runs almost all the time when you hear about smart contracts, NFTs, they're all going on Ethereum. So decentralized betting, and I've gone through some of the use cases for Ethereum here a lot, and I feel like it's a lot of people out there don't actually use it on their day-to-day, which is a little bit, which makes it a little hard to explain. But I do think that this Ethereum thing kind of is one of the main tools in the new Web3 crypto economy. So we really have to follow it. Obviously, for those of you who are unaware, it's the second largest cryptocurrency after Bitcoin, and a lot of tokens live on the Ethereum blockchain. So there's a lot of coins that kind of piggyback off of Ethereum. So what does it mean in the world without miners? On the plus side, it costs less to run the network. It probably leads to greater Ethereum value in and of itself. It will lead to faster transactions, less fees, because the miners no longer need to be paid. It lowers the inflation rate of the new Ethereum being created. So it could lead to a new bull market in that way, just like historically with Bitcoin, There have been Bitcoin halvings periodically every 4 years where the amount of issuance gets cut in half. And that usually has been followed by this huge bull run. Now, that hasn't happened for smaller coins that have cut their issuance. And I think it's because the crypto market is such, is so controlled. But Bitcoin is such a big gorilla in the crypto market that maybe for smaller ones it doesn't affect. But Ethereum being number 2, maybe it will have a very large effect. We can guess. So that's the case for it. So what are the criticisms? What can go wrong? Well, first of all, without the miners, Ethereum will be validated by far fewer organizations than it had been before. So it'll be validated by the largest Ethereum holders, perhaps the development organization, a few organizations, perhaps some volunteers. It's still an open system, so anyone can still validate and be a validator for Ethereum in a proof of stake system. But there's far less of an economic incentive to do so. There's some, but far less. So the mining becomes less decentralized. It becomes more centralized. That possibly means it's less secure in the sense that, not in the sense of like your Ethereum is going to be stolen or anything, but possibly in the sense that there might be more wiggle room for these validators to kind of manipulate the rules in favor of the big players. Possibly, the possibility has been brought up, can they censor transactions? Right now, the culture is to say, no, we don't censor transactions, but we know how fast that can change. So that is certainly a downside. And it also means that certain types of government regulation will be easier, as we'll see in a minute when we talk about Tornado Cash, which is the big crypto news over the last couple of weeks. One question that I ask myself is, could there be like a total disaster when this happened, where the entire ship goes down? And, I hope not. There's so many billions and billions of dollars, I think $100 billion riding on Ethereum. I kind of doubt it. I've thought about the proposal, and I've read a lot about the Ethereum proposal and gathered a lot of opinions. And generally, the criticism of the Ethereum Merge seems to be centered on around, well, Ethereum is becoming something I no longer want or no longer support. It doesn't fit into how I think cryptocurrency should work. I don't think it's going to be as valuable. But because this has been in development and tested for so long, the tech will very, very likely work, and the network will continue. If I'm wrong about this, obviously it'll be a huge learning moment for many involved. But even the biggest critics who are saying it's very dangerous are saying it's still very likely to work. But, we'll find out. But something else could happen. Something really interesting could happen. And because a lot of people are asking, well, all these people invested in this mining equipment for proof of work. They bought computers, they bought ASICs, they bought specialized hardware. What happens to the miners? They get put out of work. I guess that was the headline in an Ars Technica article. They all get put out of work, which I'll link on the Local Maximum, localmaxradio.com/240. There is some speculation, though, that they have a few tricks up their sleeve. One is that they can move to another coin called Ethereum Classic. So Ethereum Classic was Ethereum. This was the last time there was a split back in 2016. Let's see if I could explain it. Basically, one of the big smart contracts in Ethereum that was doling out lots of money to lots of people, someone found a hack and stole a lot of money from it. And the people in Ethereum Classic said, well, code is law. If you can hack it, you get it. That's great. We're just going to keep going. The Ethereum developers said, wait a minute, this is really bad. Let's change it so we could kind of undo that, and we'll just give ourselves a mulligan. And so that became Ethereum. Ethereum Classic said, no, we're going to stick with the rules that we have. And Ethereum Classic has had a much smaller community, but it has maintained some value over the last 6 years. And so basically, if you had Ethereum before 2016, you were able to split your coins. So if I had 10 Ethereum, I then had 10 Ethereum new, and then I also had 10 Ethereum Classic. So you got to enjoy both coins, and you can kind of sell one or sell the other. And both chains have survived on. Ethereum has done much better than Ethereum Classic, but Ethereum Classic has been not too shabby as an investment. And I think 95 of the smart contracts in the world are on Ethereum, but Ethereum Classic has some, and these things don't seem to die. They seem to just keep going on and on. Maybe because there's speculation that they can kind of, they can kind of piggyback off of one of these big events, and then some new interest comes in every few years. Okay, Ethereum Classic, they will stay on proof of work. So anyone who was mining on Ethereum can now mine on Ethereum Classic, making a lot less money, but they already invested in this hardware, so might as well do it. Some of those miners, they want to fork off again of Ethereum to create their own coin, now called ETH POW, Ethereum Proof of Work. So it's like, okay, Ethereum can actually split again. And then, so anyone who holds Ethereum now, people hold a lot less Ethereum now. Let's say you hold one Ethereum now. If this fork occurs, then you'll have one Ethereum and you'll have another FPOW. Now, currently futures are being sold of FPOW. If it exists, they're worth $50, according to CoinMarketCap, or about 3% of the price of Ethereum. So that means if that ends up being the price, if you could somehow split your Ethereum and FPOW very quickly and sell that, usually it takes some technical know-how and time. And usually if you have your coins, like say in Coinbase, that's not going to happen. But you could get something like a 3% dividend. So not necessarily bad for ETH holders, although it could cause some chaos in the kind of industry as a whole and in the landscape as a whole. And of course, so that's just kind of the futures price. All of these things are worth nothing if the split doesn't happen, which means I think if it does happen, it would probably be worth a bit more than $50. But it gets really messed up if this happens. So first of all, a bunch of people have been staking their Ethereum early in anticipation for this merge. And so now that becomes staked Ethereum, and they can unstake it once the merge occurs. And that becomes Ethereum used for proof of stake mining. Now, in the chain that relies on proof of work still, that never happens. So if you've staked your Ethereum, you might have gotten some interest off of that on the Ethereum chain, but it's going to be stuck forever in the FPOW chain. So you would not be able to take advantage of that fork. I'm guessing it might be about even how much you get. Maybe it is even. Maybe you got interest here and or you could have gotten the fork here, and either one you would have gotten the same amount. But it'll be kind of interesting to compare those two choices if that happens. And also, Ethereum is a lot more complicated than it was in 2016, the last time it split. So if it splits now, does that mean that every token built on Ethereum gets split? Every smart contract let's say I create a token. Let's say I created a token on Ethereum and it was called MaxCoin. Does that mean that now there's a MaxCoin Ethereum and a MaxCoin POW, depending on which chain we're talking about? So that means like every token splits and every smart contract splits. And if you have an NFT on Ethereum, now there are two versions of that NFT. There's one version on Ethereum and one version on FPOW. Can you sell one and keep the other? What if it's, what if the use case for that is is kind of a proof of authenticity, which is like how a lot of these things are sold. Now there are two of them and you sell one and one person owns one and one person owns the other, then whoever is recognizing that proof of authenticity will have to choose which chain they support. It'll probably be the main chain, which means the FPOW version wouldn't be worth anything, but they might put some weight in the FPOW version. I don't know. If someone created a token on Ethereum like wrapped Bitcoin, so that's wrapped Bitcoin is when you kind of give an organization your Bitcoin and then they have a token on Ethereum that represents that Bitcoin that you could exchange back into Bitcoin. If you have wrapped Bitcoin, then there are not two versions. What they'd likely do is they'd likely say, hey, we'll pay out Bitcoin on the main chain. If you still have wrapped Bitcoin on the FPOW chain, do they say you just get nothing? That's what I'm guessing, which is okay because now you have it on both chains. And if you wanted to buy it on the FPOW chain, then you'd know at that point that they're not recognizing it. I hope I'm making a little sense here, but you could just see how complicated this gets. And of course, I think sometimes things will work on both chains. If you have some bet on Ethereum that, if perhaps some bet on the internals of the system, let's say you have some bet on, how many blocks there'll be at this point in time, and the bet pays out in Ethereum. Well, the bet might pay out one way in ETH, and it might pay out another way in ETH Classic. It might resolve on both chains, could resolve the same way, could resolve different ways. All sorts of different weird things can go on. And so all of this complication, I started thinking of it, and it makes me think that this fork probably will not happen just from the complication, just from how complicated it gets. Or if it does happen, it will be worth very little. But we'll find out. And it'll be fascinating to see what happens in this point of the crypto saga. It seems like it's much cleaner for them to just go to ETH Classic. And ETH Classic, the ticker symbol for that is ETC. It can be bought and sold in almost every exchange. It might be an interesting investment right now. I don't know, for that reason. All of these different approaches for crypto are being proposed, and people are arguing very vociferously for them. In a few decades, we'll know which approach won out. But for now, we just have to follow in real time and make some educated guesses. I don't know, I don't know if Betamax is going to win or not. Now we know, but back then you didn't know. Okay, so now, what is happening with something called Tornado Cash? That is an interesting story. Tornado Cash is what's known as a mixer. Imagine a mixer like this. Suppose we all have $100 bills. I should have actually brought a $100 bill to this for a demonstration. But suppose I am holding a $100 bill, but the bills are marked so that they can be tracked by the government or something like that. A large number of people put their $100 bills into a pool and the bills get mixed up. I'm imagining one of those carnival machines where it goes into a tornado because it's Tornado Cash. And now everyone pulls out a different $100 bill, and the chain of custody is kind of is mixed. And it kind of makes it harder for the government to track these transactions, or if we're not going to get into zero knowledge proofs, but it basically makes it impossible to track these transactions. Because Tornado Cash is decentralized, it's a decentralized Ethereum smart contract, the government can't stop it directly. But they were able to stop it indirectly. Of course, this is the type of thing Ethereum was created for, to have smart contracts that the government can't stop. But it looks like we have our ways. Government is now trying to stop it by sanctioning coins that have been used by Tornado Cash. So it's like, I don't know if you've been using your coin for this way or that way, but I know you got it from the tornado. So this means that if it's not funded, that if it's been through the system, even if you weren't doing anything wrong with it, those funds are still sanctioned. So Tornado Cash, the developers, I believe, have been in the United States. They've been shut down. Essentially, the Department of Treasury has imposed sanctions on them. And, if you're feeling about the word sanctions, you get the feeling of international sanctions. Yes, it's the same type of thing as international sanctions, because they think that some of these countries, these rogue states, have been using it. That was my main question. It was like, what does that mean, sanctions? So far, unless Ethereum centralization makes this possible in the future, it doesn't mean that you can't spend those coins if you use Tornado Cash, you got out, and trade them. But for legally operating US businesses, that'll be illegal. So it would have to go underground. So that breaks what's called the fungibility of the coins. So fungibility would mean that each Ethereum is equivalent to every other Ethereum. Each Bitcoin is equivalent to any other Bitcoin. If I have a $100 bill, you have a $100 bill, we trade, we're even. They're worth the same thing. And we see in this instance how the question of whether Ethereum is fungible is well, the answer is not quite. And of course, that goes for Bitcoin as well, because you can kind of track the chain of custody. And in some cases, it can be flagged, although it's not very common for most use cases. So another question that this raises, see, I'm not... I'm not developing in the ecosystem, but I am good at raising questions about technology and also and legally what's going on. I think the question this raises is how far and how fast do we go down the slippery slope of what happened to Tornado Cash? Are they going to track everyone? Obviously, you can't know what what's happening in every wallet and every, the ledger is pseudonymous. Anyway, I should be better at pronouncing that word, but you can't track every single wallet. And they don't. I don't think they want to. But how far can we go in the future in terms of how much freedom that these things were supposed to represent, how much privacy these things were supposed to represent will be lost. So when I analyze a slippery slope argument, I often ask, is there a counterbalancing slope? Is there a way to push against it? And I think in crypto, there is, even within the Ethereum ecosystem, I do think you'll see alternative privacy solutions and ways to transact even ways to transact in sanction coins effectively. I think they'll be worth a lot less for people who are transacting on the black market. I don't recommend it, but I'm just saying, like, I think because there's a lot of unstoppable code in Ethereum as of now, there'll be ways of doing it. So I think we do have an arms race between regulators and the developers of this technology. I do think the maximum applies, like, the internet sees censorship as damage and routes around it. So I think we'll see some of that. Hopefully for right now, if you're not running a rogue state or you're not involved in a kind of a massive money laundering operation, you won't be targeted. But if you look for privacy options and invest in them, then you'll protect yourself for the future. And so hopefully I'll be looking for some of that. There are reasons to support privacy, remember, of others, even if you don't need it yourself. It's all about, like, what kind of society do you want to live in? So rather than being a FUD or a negative story, we can look at this kind of Tornado Cash thing as a way to catalyze innovation and as a way to get people looking at privacy in terms of Web3 cryptocurrency and just privacy on the internet in general, which more and more people are interested in. So other related developments to look into, if you're interested in privacy coins, one that we can look into more, particularly maybe another episode, is Zcash and other privacy coins. Zcash, I believe, is a truly fungible cryptocurrency. It's small. It's got about a $1 billion market cap, as opposed to, I think, $500 billion right now for Bitcoin, $100 billion for Ethereum. So much lower. Another one recommended is Monero. These are relatively small. Some people are interested in. Perhaps there will also be features built into Ethereum and Bitcoin that approach this level of privacy. We will see. Another development, of course, that we've been following on the show is the Lightning Network. We covered the Lightning Network, which is built on top of Bitcoin. We covered it in episode 212 with Guy Swan back in February. I think it's a good time to check back in. The truth of the matter is, just in terms of thinking about what happened to Tornado Cash, if you have a custodial Lightning Network, if you're relying on some third-party service to run the Lightning Network in order to pay people back and forth, then you have to stay within, pretty strict regulations and controls of whatever country you're in. With some technology work, you can get around this, such as running it yourself. I admit I haven't done it yet, but it still remains to be seen whether that will be something that will happen a lot or a little bit. I think that most people are just happy using the easiest version of the technology. We've learned that from the internet, and so that has the least amount of privacy, and maybe people don't care. But hopefully, there's some innovation in terms of making it like a truly. I think what we want is like a truly private, decentralized, uncensorable monetary system. At least that's what a lot of people who believe in freedom want, and a lot of people who are involved in Bitcoin want that. Okay, so, another way to look at it, maybe, Lightning is about fast transactions. And I think people should possibly rely on the main on-chain layer of Bitcoin if they want the full, uncensorable power of Bitcoin. Is that going to be enough? I think it makes sense, but I guess my open question is that going to be enough? So Coinbase did some research on that. The people at Coinbase, they put out a whole article about Lightning Network recently. So some of the biggest crypto companies are interested in this kind of technology, and they've been very impressed. The post is called "Is Bitcoin Lightning for Real?" They say that the Lightning Network shows impressive growth, and the growth has continued over quite a few number of years. It hasn't just been growing for 2 years. It's been growing for like 5 years at a good rate. So that's pretty good to see. The growth is denominated in Bitcoin. So the amount of transactions in the Lightning Network goes down in terms of dollars when Bitcoin goes down in dollars. So it's very interesting. There's kind of a good question about that. Is what's the right metric? I think they've got it right that the right metric is to denominate it in terms of Bitcoin. And so, you don't see those ups and downs in terms of just the price of Bitcoin, but I feel like there could be an argument on the other side. So it keeps growing in terms of Bitcoin, how much value is in the Lightning Network and how much is being transacted. They believe at Coinbase that this could one day disrupt payment processors like Visa. So I'll read the last section for you. This article should not be construed as an indication that Coinbase has imminent plans to add support for Lightning. Rather, a few employees at the company simply found its potential compelling enough to research, write, and share. With that said, it's not hard to be encouraged by the growth that Lightning Network is showing, particularly over the last 6 months. It is noteworthy that this growth is coming in a bear market where Bitcoin fees are relatively low. In a future bull market, we could see Lightning activity spike as fees on the base chain rise, sending users looking for cheaper ways to transact. If growth of the Lightning Network continues, it will have major implications on the future utility and value of the world's oldest and most valuable digital asset. So these are some interesting things to think about. What do you think? Join our locals, maximum.locals.com. Tell me what you think about all this stuff. People in the cryptoverse tend to have very strong opinions. I tend to kind of read and amalgamate lots of different opinions. So I'm curious to know what you think. You could also email the program, localmaxradio@gmail.com. Seriously, if you have a particular take or issue of anything I just said, let me know. I'll read it on the program. So now, and by the way, I admit I'm going to have a jingle for this, but I don't have a jingle for this, so I'll just do the drum roll. Now is, that kind of made that coil give me some of those. Drum roll, please. Distribution of the week. We're going to talk about the multinomial distribution. So what is the multinomial distribution? It's probability distribution in terms of our probability distribution of the week segment. I often use this interchangeably with the categorical distribution. So if you remember from a previous episode, the categorical distribution is just when you have several different categories of events. Maybe you're rolling a die and you have 6 sides. So the event is going to be one of those 6, 1, 2, 3, 4, 5, 6, and you assign a probability to each one. So that's a categorical distribution. But a multinomial distribution is like that, except you repeat it multiple times. It's essentially categorical distribution that's repeated n times, and then it's a distribution of the counts of the results that you get. So if you remember correctly, if I remember correctly, a couple episodes we went over the binomial distribution, And this is a multinomial distribution. Well, it has the same word. Binomial distribution just means a two-category multinomial distribution. And so that's when there are two categories in n trials. So you have a coin that you flipped, a weighted coin, and you flip the coin a whole bunch of times, and you want to see what the results could be. So let's say I flip the coin 3 times. I could have 0 heads. I could have 1 head and 2 tails. I could have 2 heads and 1 tail, or I could have 3 heads and 0 tails. So if I flip the coin 3 times, that gives me 4 different possible outcomes, interestingly enough. So it's 2 outcomes each time, overall 4 different outcomes, and that could all kind of be plotted on a line. And so each of those 4 outcomes are going to be assigned a probability. So the multinomial distribution is like this, but it gets so much more complicated because if there are more than 2 categories, there's so many different ways the chips could fall. So, for example, let's suppose there are 5 categories. I have some kind of 5-sided die or something, and I have a pentagon die, or I don't know. And then I have 10 trials. Well, how many different ways are there to, how many different outcomes are there? Well, I could have all 10 be on one category. So that's 5 right off the bat. I could have 9 on one and 1 on the other. I could have 8 on one and 2 on another, and then 0 on the rest. Or I could have 8 on one and then 1 on category 2 and then 1 on category 3. And so, there's so many different ways to partition these trials among the categories. And so this is really at the heart of combinatorics in mathematics. There's a lot of really good mathematics here. Each of these configurations, and there's a lot of them, now have to be assigned a probability. Let's take a simple example. Let's say trinomials. I have 3 categories, and let's say I run it twice. So I could have both in category 1, both in category 2, both in category 3, or I could be split between 1 and 2. I could split between 2 and 3. I could be split between 1 and 3. Okay, so there's 6 possibilities there. That's not that bad, but you can imagine it gets worse and worse as you go higher. And unlike in the binomial distribution, where you're taking from one category and adding to another, because there are so many different categories here, you can't really plot this on a line. So the kind of dimensionality of it grows. We spoke about Pascal's triangle last time, which is related to the binomial distribution. So if you have a fair coin and you flip it twice, then there's, if there's 1 chance it'll land on both heads, there's 2 chances for it to land on 1 heads and 1 tails, and there's 1 chance for it to land on both tails. And so that's a 1, 2, 1. And then if you flip it 3 times, it's 1, 3, 3, 1, et cetera, et cetera. Now Pascal's triangle becomes Pascal's simplex. And we know from previously discovering the simplex is a multi-dimensional object. So you can't really write it as nicely as the Pascal's triangle. But just like the Pascal's triangle uses the binomial theorem and the binomial distribution, Pascal's simplex uses something called the multinomial distribution, and these have been worked out. Binomial distribution is n choose k, so it's like, okay, if I have, if I did 10 trials, how many ways are there to choose 4? Let's say four coin tosses landed on heads, but I don't know which 4 of the 10 because they're numbered. So which of the 4 of the 10 landed on heads, and how many different ways are there to get 4 heads if you change which ones are heads, but there have to be 4. That is the binomial distribution. The multinomial distribution, you have like many different categories to choose from, and so it gets very complex. But I will assure you, maybe I'll do something at the whiteboard to make it more clear, because this is not something that you can't use this audio format to go through math like this. But it's all been worked out, and it's really cool math. And the multinomial distribution is applicable to many real-world applications. It's basically any probabilistic event that has a finite number of outcomes that's run a certain number of times. So any repeated experiment where the outcome is categorical. And that happens all the time. There's actually an example from Foursquare, where I used to work, and we talked about this all the way in episode 3, where in venues, people were leaving ratings on Foursquare venues, and there were 3 different emoji ratings that you could leave. There was like, dislike, and meh. And even though there's kind of a, there's kind of an order to that, it's like is the best, meh is in the middle, and dislike is the worst. We kind of could consider them as 3 different categories of what a person rating the venue will choose. And, if we consider each person rating as independent, then we can look at the distribution of likes and dislikes and meh. And so I did a bunch of models for Foursquare that assumed modeled that as a multinomial distribution, 3 different categories. And it worked very, very well. So this raises the question, could you have repeated applications of infinite distributions? And, I think you can. I'm sure it's been studied. We will have to get back to you on that. But for now, I'd like to know, do you have any good examples of multinomial distributions that you've used? Or do you have any questions for me about this? Please let us know at the locals, maximum.locals.com, or if you just want to shoot me a quick email, shoot me one at localmaxradio@gmail.com. Next week, we're going to talk about the trend of no code. Could it be any good if people want to write no code at all? Well, it turns out that there's a little bit more to the no code movement than just writing no code. So my guest will explain that to you. Also, an interview on the connection between category theory and databases in computer science. Really fascinating foundational stuff that's right up my alley. So I think with some of these interviews, we're kind of getting into the meme with the brain that's like shooting out lasers at this point. Like at first it's kind of light. Now it's like really shooting out all the lasers. So we might have to stop on our way to doing all these episodes with kind of a few fun episodes and social criticism or complaining about stuff or do some episodes with Aaron along the way, because this is getting pretty insane. Have a great week, everyone. That's the show. To support the Local Maximum, sign up for exclusive content and our online community at maximum.locals.com. The Local Maximum is available wherever podcasts are found. If you want to keep up, remember to subscribe on your podcast app. Also, check out the website with show notes and additional materials at localmaxradio.com. If you want to contact me, the host, send an email to localmaxradio@gmail.com. Have a great week.
Feel the power.